Good everyone, this is Capital FSN Academy. This video is actually made for those of you that is just coming into the trading industry, because I discovered that a lot of you are getting things wrongly. I was scrolling on my TikTok and I saw someone that made a video. He said he had been trading since 10 months ago and he's now good, that he's an SMC trader. Well, let me just make this thing clear. You see, SMC, ICT, all these things are just names given to a group of strategy. You understand? Just like coming into a house and taking one room and saying you only know that one room. That's just how it is. But you forgetting that there is actually a roof that covers the whole house, like the house contains different rooms. So you're not saying you are SMC traders. Some of you does not even know how SMC came about. They will just tell you mark another block, do this, do that, or ICT. Now ICT looks majorly on the price actions, while SMC looks majorly on liquidity levels. Now let me explain it. Most people that trade ICT, they are most of them always take CMP trade, like current market price. For those of you that don't know the meaning of CMP, they enter the market to execution. Why SMC traders mostly they wait for the market to come to their other block. Now, how ICT traders trade most of the time is that when a candle comes to a zone where they expect it to reverse from and they form a rejecting candle, that is the price action, then they will jump into the trade immediately. But SMC traders most of the time does not even need to wait for the rejection candle. They already know that this other block, the market can play around whatever you want to play, or it should reverse from this zone. And that is why sometimes when you are trading, you see ICT traders, their stop loss is always tight. But SMC traders always have their stop loss to be kind of wide. Not that wide, but at least to cover the other block. Yeah, but you as a new person into the industry, I want you to understand something. All those strategies, it works. Yes, it works. But the way you people go about it, you will get it wrong. It will not help you if you follow it that way. And I have my reasons. Let me explain it. It's just like you being in mathematical class and they teach you you read one question, solve it right, and take you have known that topic. No. Each formula has a derivation. There is a way they brought the formula, there's a way they drive the formula. They will not start telling you that this formula, you bring this law from so place, especially those of you in physics. Physics is more of further mathematics. So most of the formulas in physics are like deriving from further mathematics equation. So that is just how trading is. All this ICT, SMC, IBB, I even saw one saying ICM or what. All of them are just like an equation that is deriving from another formula. You understand? So I want to explain this thing this way. If you want to start trading, first thing, very, very important, first thing is support and resistance, demand and supply. They are number one. See, let me tell you the reason why you need to understand support and resistance or demand and supply. The reason is that every strategy are built on this topic or this strategy. All of them, go and look for them. If you are not grounded on support and resistance, my dear, you are just wasting your time. Yeah, you might think you are being profitable, but sometimes the movement of the market you will be like being confused, because some movements you'll be like, why did it happen this way? But the law of this says this. The law of this says this. Now let me clarify you. Law of support and resistance says that when a market breaks a support or a resistance zone, you expect a retracement. Now, before the retracement, the law went further and said that on the retracement, you expect to see either white or black soldiers after the breakout. If you see white or black soldiers, that is what will make the breakout to be stronger. Now, let me explain. When a market breaks a support or a resistance, let's just say it breaks a support zone. The market breaking a support zone, then form breaking a support zone, it will use a green candle, which is bullish. Sorry, if you break a resistance zone, if you break a resistance zone, it will use a bullish candle because it's a bullish momentum that broke the zone. Then at that zone, you should have at least 3 green candles above it before any red candle can come in between. If it happens that way, that is an aggressive breakout. When it forms, most of the time it picks the breaker block. That means it will come back and retrace to that structure, that support zone. Immediately after retracing to that zone, it can move from that zone. It might not release a wick, like try to clear liquidity, because it's an aggressive breaker. You understand? But if a market break a structure and within 1 or 2 candles you just see a bearish candle, most of the time it doesn't pick that resistance. It will go below the resistance. That is what they call a fake out, and that fake out is what you normally see as a market breaking a sub-BOS, breaking your structure, come back for a retracement for the other block at the week, now picking it. Now let me tell you more. Now you doing SMC, you mark a other block. Now your SMC goes this way. When a market, let me explain it. When a market make a move, make a high, this is your support zone, you understand? Then you break this high, this place. Where do you expect? Where the movement started that broke this zone, you look for your other block there. Then when it broke is your breaker block. Then you are waiting for the 2 zones, right? Then your stop loss will be below it, right? Now go back to the law of demand and supply. Demand and supply says that if you take a position on any demand zone, your stop loss is supposed to be below the previous demand zone. Why? Because the previous demand zone is stronger than the recent demand zone. That means when a market leaves a demand zone without coming back to retrace that demand zone and forms another demand zone as it is moving, the recent demand, the current demand zone that the market just formed, yeah, it is strong, but it's not as strong as the previous demand zone that the market did not feel. That is why most of the time they call it inducement. Yeah. Or some people call it liquidity. You understand? So all these things are how the market has been about, but you are learning strategy, you don't even know how it started. Now, okay, let me clarify another thing again. Market is making a structure. Higher high, higher low, higher high, higher low. Now, a market makes a higher high and you want to take a trade on a higher low. You don't just jump into a trade on a higher low. First, when a market is making an uptrend, you need your support from trend lines. Now, why are you using trend lines? You use trend lines to mark out the possible area of liquidity clear. That does not mean that it's actually that trend line that the market will pick. Most of the time, markets break the trend line and goes to the previous demand zone. You understand? That trend line is just showing as a staircase, telling you all those places the market has left, it's liquidity the market left there. So all these strategies you are learning is just kind of changing the language. Fake outs, support and resistance will tell you a fake out, then demand and supply will come out and tell you, SMC and ICT will come and tell you break of structure. You understand? And they pull back. They didn't tell you in detail how it works. Then another thing is support and resistance or demand and supply will tell you imbalance, or yes, it will tell you imbalance. Then ICT mostly will tell you FVG, fair value gap. But do you know how imbalance works? Do you know what prompts the imbalance? Now let me explain it for those of you that don't have knowledge. If you study your candlestick pattern, the law of candlesticks says that each candle, these 2 pairs, both your bullish and bearish candle, is like twins. They can't go without each other. So wherever you see green, you're supposed to see a red balancing the movement. So let's assume you see a bullish momentum moving up, it's a green candle. There's supposed to be a bearish momentum balancing the green candle. So once you didn't see the bearish momentum, the movement balance, just like you doing your hand this way. So this one is green. You understand? Green candle goes up, red candle will come back and fill it up. So it will just be going this way. That is how it's supposed to go. But whenever you see this one going up alone, then just know that this one will definitely, as time goes on, it will definitely come back to fill in the gap. You understand? So these are the things you should not take for granted. You understand? So I believe I'll be making more videos kind of pointing out some things that you need to understand for those of you that are just coming into trading, because it is not actually interesting whenever I see some people just saying SMCICT. What is that? In fact, you're not supposed to start. You are just 10 months into trading industry and you're saying I'm an ICT trader. What do you know about trading? How do you know? How did it start that you know? So that is the thing. So watch out for next videos. I'll be pointing out some things that you need to learn, and I'll be giving you some keywords that they change just to manipulate you, so that you get it wrong. Sometimes you'll be like, oh, I'm getting this thing wrong, I don't understand, I do this, I do that. No, see, you don't need to check. You understand? Just calm down, and I will be explaining it one after the other. And if you want to watch the complete videos on how I've been pointing out some things and how I explain things in details, just go to YouTube. Check my name, Capital FXM. Just search Capital FXM on YouTube. Check my videos. Some of them you might find it interesting. Some of them you might be like, oh, I know this already. But check it. At least practicalize it. You enjoy it. Thank you so much, guys. Have a nice day.